Have you ever wondered how high Phantom's FTM token could go in 2025? Well, if you have, today's your lucky day. Today, we're going to be taking a look at the FTM technical analysis, where I'll be sharing my FTM price prediction for 2025. As I get into today's video, if you do find it useful and informative, smash the like button. If you are new to the channel, subscribe, and let's jump down into the charts and take a look at what's going on with FTM. Okay, so we're going to kick things off with this chart here. This is Phantom paired up with USDT. We're on the 1-day Binance chart. Now, in order for us to be predictive over the future of FTM, we need to obviously be able to use a couple of tools to help us understand the market and understand where we think the most probable outcome or the most probable price action is likely to take FTM. Now, for this, there are a couple of tools that we are going to use. We're going to use the Fibonacci retracement tool. Okay, this is in TradingView directly, this one here. Okay, this is basically allows us to check the psychological Fibonacci levels with the kind of buying and selling behaviors. This is quite important, and it's one of the most widely used tools in kind of technical analysis. Okay, now in here, I'm going to show you my settings. You can pause the video and take a look at these if you want. If you want to kind of copy this these settings out. Essentially, I have all the standard stuff. So 0, 0, 2.36, we have 0.382, 0.5, 0.618, 0.786, 1. So that's your standard 0 to 1. And then we have some extension levels. So we have 1.236, we have 1.382, we have 1.618, and we've got a couple of additional ones that I use. So we have 0.702 and 0.882. These two are key areas that I use. One, the 702 is a Bitcoin area that Bitcoin reacts to, and then the 882 is critically important for the other tool that I'm going to use in today's video. Right down at the bottom here, there is fib levels based on log scale. I have this ticked. It's very important that we tick this. If we do not, you can see how these Fibonacci extension levels change, and this is because I am using a logarithmic style chart. If I don't, it will look like this, which is quite unusable from us trying to analyze where the price action is going. Whereas if I have it in logarithmic style, here we can actually analyze all those price movements. Because I'm using a logarithmic style chart, my Fibonacci retracement tool must be in logarithmic. So that tick box. By default, this is ticked off, okay? So make sure that is ticked on if you are using logarithmic styles. Otherwise, you'll end up with all the wrong numbers on your fib charts, okay? So that's the first tool. The second tool that we're going to use is Elliott Wave. Now, Elliott Wave is a fantastic predictive tool, and it is quite a complicated subject, which is why I put together a whole course on it. You can find that over at 𝗕𝗘𝗪𝗀𝗠𝗏𝑐𝑜m. Usually it's linked in a description down below, where I do run the occasional 50% off discount code for anyone who's interested in learning it. Ultimately, the Fibonacci sequencing and Elliott Wave combined gives us very predictive capabilities. Elliott Wave is incredibly predictive. What it does is it tracks the behaviors of buyers and sellers. It's the behavior that we're most interested in. Okay, these run in 3-wave structures or 5-wave structures, although there's lots of variations of those. It's going to be relatively straightforward in the analysis, in my opinion. Obviously, more details can be found on the course. So those are the two things. We don't need anything else, right? We don't need the 50 EMAs, the 200 EMAs. We don't need any of that. We leave them on the chart because they're good to reference, but we don't use them for the analysis. All we're going to use are those two tools. That's all you really need. You don't need lots of fancy indicators. All you need to do is be able to use price analysis, and you need basically to be able to see where the behavior is changing, okay? So let's go ahead and take a look at our chart then. So in here, we have a reasonable amount of data on this Binance chart. We have on the low side a bear market low of March 2020. Okay, we have a bull market peak up here. And I'm going to zoom in just so that we can see the exact peak here was in the early stages of the bull market. So actually it wasn't that early, to be fair. This was October 2021, and in January 2022 it tried to have a relief run but didn't go very far. Okay, so yeah, actually kind of in line. I thought that was going to be a little bit earlier on, but I think that's this way. Yeah, May 2021 is over here, corrected down, and then we had that final blast to the upside. Okay, so we have a bear market low point and we have a bull market peak in the previous previous cycle. Now, this is important because what we want to do is we need to understand the behavior that led into this move to the upside, okay? And understanding how those people were buying into FTM and the kind of psychology in their reactions to the market helps us be predictive over what is likely to happen next. Based on that behavior, we can expect different behaviors later. Okay, so basically, we can also see a very interesting bear market here for FTM in 2022. I'm going to go ahead and snap that in. I'm just going to zoom in and make sure that that is, of course, the exact low that we are looking for. There's actually a additional wick. I'm just going to make sure that is the correct one on the 21st of November, and we can check that we didn't come down any lower. Okay, so perfect. What we've got going on here then is a bear market low of March 2020, a bull market peak of October 2021, and a November 2022 bear market low. So we had a bull market, we've had a bear market, and now we're kind of getting into the next big swing. But you can see that the behaviors are different, right? Without even really getting into too much of what is going on, we can quite clearly see that the behavior in kind of 2023 and 2024 is vastly different to the behavior that we saw in 2020 and 2021. So the question then becomes, what really happened here in 2021 and why was it so vastly different to what we're seeing now? Well, let's go ahead and take a look at that. So with our 2020 low point, we saw a very explosive move to the upside. Now, the time, this was also during the pandemic, there were lockdowns, there were stimulus checks being printed. There's lots of reasons that you saw this. Lots of people had lots of spare time and some disposable income to essentially throw at the market. Now, not everyone during that time obviously had disposable income, but there were a lot of stimulus checks that were, given out to people who didn't necessarily need it. And so they didn't really have anything else to do other than kind of, invest it in cryptocurrencies or the stock market or take part in the GameStop scenario in saga that kind of was unfolding at the time. But ultimately, you saw a very explosive move here. And it's very explosive. You can kind of see that we have these kind of really big moves, little mini corrections on the journey, but basically it's very much all these moves to the upside, very little in the way of corrections, right? Your major correction does come a little bit later after you have a significant amount of growth to the upside. Again, you can see here lots of overlap between that, so it's a corrective move, and then you start getting into more explosive moves coming up into these kind of peaks here. You're going to have what is known as an irregular flat before finally finishing that move to the upside. So what we need to do is we need to understand the structure here a little bit clearer, because this correction to the downside here, so we have this 0 to 1 on the Fibonacci retracement tool, then you start correcting down just lower than the 0.618 and a little bit above the 0.5, and then we start to see a bit of a take to the upside again, right? Now, if we move that over to the existing low level, so what we've done here is we've measured from March 2020 lows to the initial peaks in September 2020. We measured 0 to 1, and then we moved the entire chart over here, right, to that low point. That's important because what we're trying to do is we're trying to measure the move that we initially saw against the move that happened next. And here you can see that it goes up to a typical area of 1 to 1.236. And you can see that it peaked right here. Now, it did get a little bit complicated because what you've got going on is an irregular flat. An irregular flat correction is allowed to have this little move higher here and also this move coming down lower here. Okay, so it's a little bit hard to kind of understand, but it is a actual corrective structure that basically allows us to see more continued move to the downside. Now, the reason that I can call this an irregular flat and nothing more than that is the idea of a 5-wave collapse in this move to the downside. Now, I could be slightly off pace and maybe this is the peak here and that's why we saw continued growth. But for the most part, it doesn't really overly matter end result because we only had one additional push to the upside. And although this did push up to the 1.618 fib level, as you can kind of see here at 338, we saw a 347. Okay, it's not impulsive. Okay, so the hope was, of course, back here in this previous bull market that we have a corrective move coming down and then another blast to the upside. That wasn't really the case, and instead we moved on to the bear market. Now, in hindsight, we can see that, but if we were actually analyzing this market in 2020 and 2021, we could see that the behaviors here, specifically with this correction right inside the middle from the February 2021 to the lows of around July 2021, that correction in the middle there allowed us to articulate this as a very corrective pattern. And instead of a kind of 5-3-5-3-5 structure, you actually ended up with what is known as a triple zigzag pattern. It's actually quite obvious when you start reflecting on it, and if you were monitoring the charts, you might have been more hopeful that maybe it was something else, but ultimately what you got was a very corrective pattern on the bear bull market to the upside. And what that means as a W, X, Y, X, and Z, guys, is that you have these 5-wave impulsive breakouts, but you have essentially got them coupled together with 3-wave patterns in between. So we go like this, and we pull in another 5-wave move like that. And that is essentially an A, B, C, A, B, and C. Okay, and what we're saying, if I zoom out even further here, is that that particular structure, that 5-3-5, that A, B, and C zigzag pattern, that is a W wave. We have a 3-wave correction going down. We then have another A, B, C, and a Y wave, another correction down, and then another ABC structure. Okay, so this entire pattern repeats itself 3 times. It's called a triple zigzag. Okay, and when you take a look at the chart, you can actually see it in here a little bit clearer. Okay, you can see how you have these zigzag patterns. This one here is actually potentially even probably an overextension towards the end there, but to me actually looks like a double zigzag. It's not, because it can't be, but for the most part you can kind of see how it's not really giving you those big impulsive structures that are actually a little bit more trend based. Instead you have a very corrective pattern. Now this is important because it means that this is actually on the face of it, it looks very impulsive. It looks like we're going really strongly to the upside in that previous bull market, whereas right now it's very choppy, right? But actually the behaviors are the same. They are acting ever so slightly differently because we aren't seeing the kind of stimulus that we saw back in 2020 and 2021 in terms of additional money flows, but also the price action is vastly different, right? So when your price is down here at 0.0017, it doesn't take a lot of money to kind of get the bull moving, right? All the way up to that 347. Instead, we bear market bottomed out down here at 1645. It means it takes more money to push the market to the upside, and we already know that there isn't a lot of retail investors in the market at the moment, and the market is pretty much being driven from institutional money, not retail money, at least all the way through 2023 and 2024 so far. That is starting to change. We're starting to see more positive numbers coming in, and we can see that within the data of YouTube or Google Trends and stuff like that. So that market is actually very much the same. The behaviors are very much very similar. So we can take a look at this. Here we can see these little mini runs looking really strong moves to the upside, very corrective moves to the downside. Again, you know that these are corrective because you have overlapping structures between these moves. Okay, that tells us that we're not in major kind of worry territory. We then have very explosive, again, 3-wave zigzag pattern moves here. You can see right here, right? Good impulsive moves that are stringing up together. And again, you can see here as well, big correction in the middle there, and then another push to the upside. So a double zigzag pattern forming there, W, X, and Y. Okay, so the market is behaving exactly the same way as what it did in the previous bull market. The difference being is it doesn't feel like that because obviously it takes a lot more money to move the needle. With that all being said, this is happening on the backs of the fact that there isn't a lot of retail money coming into the market. We still have low retail participation in the market. Mainly institutional money, market makers, whales are kind of making the market feel more buoyant, but it hasn't really had that kind of big moment. I think that's going to come in 2025. Now, taking a look at this, we can, of course, see a really interesting structure. This overlap isn't concerning to me, okay? So there are a couple of things that are going on here. We can maybe argue that there's some positives to be found in here. And I think that's a reasonable ask, actually, to think about it more positively than negatively, considering we are seeing, these 3-wave patterns. Now, this move to the downside is actually reasonable. Overlap here and here, indicating that this is not a long-term issue, okay? And the overlap here and the overlap here, or this kind of overlap in total, isn't giving me terribly too much concern because we've held the line since 2022 low over here and over here. Okay, now that's important because there's a pattern that potentially is playing out where we do see 3-wave structures like what we saw previously over this side. Now, because we can see a W, X, Y, X, and Z pattern this side, we can also argue that we've completed a kind of first ABC structure over here. So behavior is kind of mirroring what's already happened. We have a correction of pattern coming down here. Are we going to be looking for another 3-wave move to the upside? Well, are we actually going to be repeating the W, X, Y, X, and Z pattern that we had seen previously? Like I say, the behavior tends not to change terribly too much. And the trick here is to basically make sure you understand the buying behaviors of what happened before before, which are essentially that the market moves a bit, profits are taken, you call off, and then it just moves again. Okay, and it's kind of rinse repeat, but you can't move more than 3 times. Okay, so when you have what is known as a zigzag pattern, which is your A, B, and C structure, right? That's known as a one zigzag, right? So it's one instance of it. You can have a double zigzag, which essentially would be 2 of them, okay, and you can have a third zigzag, which is 3 of them, right? A triple zigzag pattern. Now, in the case of a double zigzag, you label that W, X, and Y, okay, and that's one instance of something. And then, of course, you have your triple zigzag, your W, X, Y, X, and Z, right? You can't have more than that. So we know that there's an upper limit of 3 zigzag patterns. With your kind of zigzag patterns can, of course, morph into something else. And without getting into too much detail, you can have a zigzag pattern to the upside, you can have a zigzag pattern to the downside, and then you can have a explosive 5-wave move. This is known as a 3-3-5. You'd still label it A, B, and C. Okay, so there's also that to kind of contend with, kind of without confusing things. My point here is that behavior of what we saw previously, the W, X, Y, X, and Z, is something that could also be forming over this side. So where is the potential then? If the behaviors of what we've seen previously in the previous bull market are repeating themselves in 2024, 2025, where does that mean that the price action is going? Well, there's a few Fibonacci levels that we can kind of use to our advantage here. And we're going to, first of all, give ourselves a bit of a head start with this one. Okay, so bear market low of 1645. What I've done is I have measured the distance, okay, between the low level of 2020 and the high level of 2021. Okay, and I'm going to go ahead and come in here and just move the Fibonacci chart that I've got to 1645. So I've measured that distance of the previous bullish market and then moved the entire Fibonacci tool over to the bear market low of 2022. That allows us to measure the distances in which we might find the price action going in 2025. Okay, so that's the first tool. The second thing that we're going to do is if we do see a W, X, and Y, so just a double zigzag pattern, where would that go? So we're going to measure the distance of the first double zigzag here, this zigzag in fact. We move that over to its low point, which I think would be the August 5th low. If I zoom in, I just want to check that we have that on the low, which would be 25.75. So I'm a little bit off. I'm just going to go ahead and adjust that down to the 75. There we go. Okay, and just zoom back out. Okay, so we've got 2 Fibonacci retracement tools on here. One which is super bullish and one here that is actually quite conservative. But there's a couple of key points here that we need to kind of point out. Okay, so on a double zigzag, our bull market peak would be in this yellow box, essentially between 192.31 and $3.09.08, which means no new all-time high for FTM. Okay, anything above $3.908 would actually mean that we are going to be seeing a W, X, Y, X, and Z. Unless we hit $6.6622, then in which case it becomes a 5-wave impulsive breakout. Okay, so although we don't have the workings for that, so you know it's not going to happen, let's be honest. So we want to be thinking, okay, we want the price action to be higher than $3.908, okay, and that would allow us then to be predictive over the next move, which unfortunately we can't be overly too predictive about based on the fact that we would need the retracement to predict out the next move, but we can kind of be a little bit, you know, clever and about that. We would be looking for anything above the 1.236 fibs level, a new all-time high, and preferably we would want to hit 1.382 at $4.14 to confirm further upside later. Okay, so what I mean by that is we would have a move up here. Let's say we hit $4.14. We'd expect selling pressure to come in, a retracement of some kind, and then a final push to the upside. Okay, and that move to the upside again would mirror the idea that you have this kind of 5-wave movement, but it's actually a W, X, Y, X, and Z pattern that we would see previously. Okay, so where do we think the upper limits are? Well, I think that we've got the conservative targets kind of set, $1.9231 to $3.09. Anything above $3.09 is going to be indicative of a bigger move to the upside, and I would say that there's a potential move somewhere in this range, between $4 and $7.24. Okay, that would be kind of like the medium kind of area of expectation. Based on obviously performance and so forth, and obviously the teams and And all of that is going to be like marketing is a key element, right? We can't just ignore those things. Now, as I zoom out of this, there's still potential for something phenomenal to happen. Now, do we think that's likely? Possibly not, but for the most part, we can acknowledge that there are some key areas here of focus. The 0.618 comes in at $17.6865, and our 786 comes in at $63.07. Do I think these numbers are achievable? Yes. Do I think they're probable? No. Okay, what I mean by that is, yes, we could potentially get there under the right circumstances, but I don't think it's very probable, as in I don't think it's likely to happen. And of course, we have higher range expectation targets, which are just absolutely bonkers, and you'd be just completely, I think, delusional to think that you can get up there in 2025. I would love to be wrong, of course, and not that I'm invested in FTM, but you can kind of see $318 to $1,900. I don't think so. But, you know, for the most part, we have a clean kind of chart here that gives us a bit of a path and a bit of a journey to success. So essentially, what do I mean? Well, $1.92 to $3, that's going to present itself with an opportunity. From our bear market low point, that percentage, if I can snap it in, would be around 1,000, so a 10x, up towards the 1,700, 17x. Okay, but that's from the bear market low of 2022 if you were dollar cost averaging down there. Now, if we get to $4, we're talking about 24x, and if we get up to that $7.24, then we're going to be talking about 42x, okay, 4,200%. Now, that all sounds great and everything, but what about the kind of current pricing? As of the point of recording this video, for example, it would only be 177% to get us to the level of 192, up a little bit higher towards our kind of $3.09 level will be a 300% move. Up to the $4 level, it would be a 490% move, and then up to $7.24, it would be about 924%. So again, we're talking about just under a 10x on the most kind of higher range expectations. So not necessarily the best. But what if you were dollar cost averaging down in August in terms of those? Well, in that particular scenario, you would be looking on the low side, conservative side, around 644%, up towards 1,000%. So you'd be looking at around 6x to 10x on what I believe to be the achievable side of things. On the kind of higher range expectations around $4 to $7, you'd be talking about 15x upwards towards the kind of 26x. Again, not unheard of, and I think very achievable. The unlikelihood, though, is if we start pushing out towards the $17, it's possible, but again, it becomes really quite difficult to get there. That's 6,800%, up towards the $63. That's 24,000%. Again, very unlikely to push that high, but again, it's still possible. So there you kind of have it, right? Some brief kind of ideas to kind of where FTM could be heading in that next bullish market. Of course, it's just my thoughts and opinions on the data in the charts. I'm no financial advisor, just kind of giving you some ideas as to kind of where I think the price action could be heading. What do you think? Let me know in the comments down below. And if you have found this informative, useful in any way, smash that like button and subscribe to the channel to stay up to date with all the content that we do here. And guys, if you haven't done so already, check that video out right there. It's not one that you want to miss.